Hey team, Jeremy Hauser, host of the Advisor Mentorship Podcast. Our conversation here with EVP of Annexus, Tom Haines, is one you are not going to miss out on as we talk all things forecasting for 2025 within the fixed index annuity space. We get Tom's insight and thoughts on our recent conversation on our previous episode with Professor Jeremy Siegel, what the industry is looking for, what vol-controlled indexes are going to do well in certain markets, and also you will not want to miss out on what Tom's research shows what the S&P 500 is forecasted here over the next 10 years. So with that, tune into this episode. Hope you enjoy.
Systems work. People fail. Welcome to InsureMark's Advisor Mentorship Podcast with Vice President Jeremy Hauser.
Welcome to this week's episode of the Advisor Mentorship Podcast. I'm your host, Jeremy Hauser, and 2025 is already starting off with a bang after the launch of our last two episodes. To our new listeners and subscribers, thank you for checking us out. And today we have a treat for you as we are joined by Tom Haines, EVP Capital Markets and Index Solutions at the Annexus Group. How are we doing today, Tom?
Well, good to see you, Jeremy. Thank you so much for inviting me back on your show. And thank you for all your listeners for joining in today. And I know a little bit of a belated Happy New Year, but we're looking forward to kicking off the year. And thanks for bringing me back on.
Of course. I mean, you were an absolute hit last year when we had you on. We talked a lot about forecasting in the industry, and I know that's a lot of what we're going to be talking about today, especially in the realm of fixed index annuities. But before diving in here, so Siegel, that was an incredible opportunity to chat with him. What were your takeaways from that particular episode of just chatting with Professor Jeremy Siegel on our last episode?
It's always a treat and it's a privilege to have Professor Siegel on, right? Here he is viewed as the greatest stock mind alive, regular contributor CNBC. He definitely helps consult really many companies. He's been brought into government committees over the years. So when you get to hear from him, what's really special about Professor Siegel is he's usually right. I've said the only time I've actually studied his calls and analysis, the only one he ever got wrong was 9/11, which obviously was unexpected. He thought the market would have a recovery in that one summer and fall. The other thing I would like to highlight is he does such a great job of synthesizing. You know, here he's a PhD, taught by Nobel laureates, friends of Nobel laureates, one of the best professors, award-winning in business, and he can just simplify it to the point that someone that doesn't have an economics background gets. So I really thought that it was insightful. And one of the things I think was important was there's this narrative right now that the new presidency of President Trump is ultimately going to just come in and change the stock market. And there's two different things, right? Having more deregulation, right? Having negotiations with countries in a different way, those can be really good things, but it's not that the president can just on a flip of the dime change the market. There's so many factors, and I think Professor Siegel reminded that, and I think he gave us a pretty good playbook of what the year could play out and what needs to play out for market stability.
Couldn't agree more. And one of the things that, and through conversations with a lot of people, yourself included, I mean, he's very pro equities, always has been. And I kept kind of hidden to him that, you know, we've had a huge run here, especially in the S&P 500 over the last 2 years. So over the last 2 years specifically, switching gears a little bit in our space within the fixed index annuity space, our industry utilizes a lot of these volatility controlled indexes. And although the S&P 500 has done relatively well, bouncing back from 2022, it seems like a lot of those volatility controlled indexes, some have actually done pretty well over the last 2 years, all things considered, but some of them have actually been flat. So maybe for the listener who are advisors traditionally that listen to this show, you know, why is that? Why are some of these volatility controlled indexes relatively flat or just barely up, even though we've had north of 40% return in the S&P over the last 2 years?
That's a great point. And you highlight some are having some really strong product performance, you know, even at double-digit level, and others are at zero. And what we look at it at Annexus is how it works at a product level, right? So there's two things just for your listeners here. There's the index, which is just, I would say, the academic exercise that that is what you're seeing on the Bloomberg or on the internet. That is not implementable. But then when you take that index and put it into a product, what are the participation rates? What's the floor? What's the fee? Right? And then you take that product number, right? And just basic math, that's what we're looking for, right? And when we think about an FIA, the product objective, as we talked about last year, is how to get around 5-6% over the long term. Can't provide it every year. That's not the guarantee, but being a better alternative in a portfolio, 5-6%. And then how to do it that you're not taking bets. If you want to take bets, you're going on your sportsbook app. You've just been betting on the football playoffs, or you're going in and gambling. This is about a financial plan with diversification. And diversification comes with allocating the different markets. So the S&P is just one market. And what we've seen over the last few years, it's actually only been about 10 to 15 stocks. We talk about the Mag 7. There's been actually lessening of a diversification at that. And when we look at the other markets, be it mid-cap markets in the US, small cap, international, emerging, commodities, bonds, those are the things that should also be incorporated within a portfolio. As much as the famous market barometer might be doing well, it will do well till it doesn't do well. We saw that in the lost decade. We saw that ultimately even 2022. So what we've been seeing is there's been pockets where the smart beta indices in the market, certain ones are picking up on things. Some to our surprise, because it's not always hitting the news in the United States. Take, for example, Global Shiller. That provided now double-digit returns, and it's one of the 5 best indices in the life and annuity market over the last 3 years. Why is that? We say, well, globally, things are weak. There's chaos in Europe and concerns in Japan with a yen is getting devalued, concerns in the United Kingdom. But when we look, actually, global value and global quality has actually done well. That has actually done well. And that's why you're seeing those double-digit returns in that allocation. Same goes with one of the indices that looks at economic outlook, the positioning of bringing in a healthy mix of the U.S. as well as global equities together with diversification has done well. Some of the things that haven't done as well has been fixed income. Right? Here, anything that has had more of a multi-asset approach with fixed income, those have unfortunately in December of 2024 have lost a few percentage points. We are continuing to be in a bond bear market that started really at the end of 2021. It obviously was exasperated into the worst bond market in 2022, 2023, and we're still there. So we remind you not to go into bonds as an asset class per se. I think FIAs are a better asset class than equities, but anything that had a bond component, even in a smart way, some of most of the strategies we bring on in Annexus, if we're seeing a bond bear market in trends, and these are rules-based strategies or outlook, it's pulling away from the bond market. That doesn't mean it's able to make money somewhere else. So ultimately, that's a long way of saying we've really seen an over-concentration of a few stocks in the S&P 500 doing well, which is concerning, and I can talk about later on this call too.
Yeah, and I know that's something for the listener too, because a lot of reportings and things that some of the experts out there who are really looking for long-term yield, S&P 500 is traditionally, it's just very expensive in our space as opposed to these volatility controlled indexes. So it is kind of challenging to overlook the success of just the S&P over the last 2 years. But then you get down to more of that pricing part of it. So especially in the interest rate environment we're in here in 2025, compared to where we were, I mean, light years ahead of where we were in 2021 and even beginning of 2022, does it make sense for the advisor to really recommend paying a fee and buying up higher participation rates within these fixed index annuities, especially where we're at in today's environment. I know 3 years ago, it made a lot of sense because, I mean, the difference between upside with paying a fee to get more participation was night and day different from no fee. But today, maybe it's not as attractive, but can you walk us through your analysis on does it make sense or not?
Absolutely. So in that fixed index annuities, if you're holding them over that surrender period, they will fully return your principal. So we want to highlight that
Mhm.
and we'll go into the discussion of the fee. But I want to remind the audience that if you're just looking at an accumulation vehicle, an index annuity, a fixed index annuity, it will provide at least your principal. So now what you're going about, Jeremy, is when you look at the strategies, many people think about S&P as caps or participation rates. And then what we see is within the smart beta universe, many products, and we have a few that allow the client with the advisor to be able to allocate to a strategy that has a zero fee structure, which would have a lower participation rate. But the insurance companies have been able to really offer a fee that's still going to protect your principal over the, let's say, the 10-year surrender period horizon
Mhm.
and buy up more participation rate. And a lot of them have done a really nice job of creating that efficiency and putting that right back to the participation rate. So I wouldn't say overall every insurance company, but the ones that we work with at Annexus, they're able to then take that fee and deploy most of it back, which is pretty attractive that you're getting this upside. And then what you're saying is that worth that? Is that trade-off worth that? And when we look at, especially working at long-term index standard forecasts, index standard, we talked about that prior, and what are their long-term forecasts? We're still seeing in the product competitiveness right out there that is worth it to do that. Now, what I want to highlight though is really from a best interest perspective, that advisor on a case-by-case basis needs to make that discussion with their client,
Correct.
right? If the client wants really the utmost level of conservatism, knowing that they're going to get their principal back after that surrender period, but they want to really be conservative, they're really looking to have very modest gains, but see something, perhaps the no fee structure makes the most sense, right? I would highlight that maybe would be prudent. Now, if they're looking to really maximize the potential of growth and they feel that their sleeping point is totally fine to adjust to because they are protected, going with the fee structures with a diverse allocation could be really, I think, the most prudent measure. I still wouldn't advocate allocating to one index. And the other thing I would say is fee or no fee, I still would manage the client expectation of probably 5-6 over the long term. Maybe if you're doing all no fee, how you're maybe at the 5 level, you manage your client's expectations there. But then versus if you're taking more fee structures and you feel maybe you could say, well, we're going to go 5-6. I wouldn't say though, I would change your perspective and say, now we have an equity replacement. It can happen, but let's just really utilize the fee with diversification to maximize the probability of hitting real results.
You may ask, who is Athene? Athene is a prominent retirement services company dedicated to helping customers retire with confidence. They only specialize in annuities and they do not offer life insurance, long-term care, nor health insurance. Athene's impressive growth in the annuity market has led them to manage $355 billion in assets. They also hold an A+ rating from S&P, Fitch, and AM Best. In 2023, Limmer ranked Athene number one in fixed annuity sales with $34.7 billion with a B in sales. Limmer also ranked Athene number one in fixed index annuity sales for 4 out of the last 5 years. They have been able to grow at a very rapid rate due to the following: a diversified product offering with excellent renewal rates, industry-leading crediting rates and index performance, a continued commitment to producers, offering a winning formula of programs and incentives, regardless if your clients are looking for protection, accumulation, guaranteed income, or legacy. Athene has a solution for you. If you would like to know more about Athene's products, make sure to go to www.insuremarkamp.com/Jeremy and click on Learn More to provide your information there. Athene, driven to do more. Are you an advisor currently working in your business instead of on your business each and every day? You are not alone. We come across advisors every single day that are constantly asking us, what can I do to get better? How can I go from being an advisor to a CEO? How do I delegate? If you find yourself asking you these same type of questions in your business to your team, you're in the right place. Make sure to check out our resources here at www.insuremarkamp.com/Jeremy. You can hear from successful entrepreneurial advisors like yourself as they have plugged into our systems and processes and continued to scale their business. If you are an advisor that's looking to go from advisor to CEO, make sure to go to www.insuremarkamp.com/Jeremy. Click on the Learn More section, insert your information. We'd love to get our introduction kit to you. Now, back to this episode. I couldn't agree more. One thing to definitely highlight, well, mainly two things. One is, to y'all's credit, not all insurance companies and not all products actually, for the opportunity to buy up participation rate, do give the consumer back that fee. So to y'all's credit, at least with the Annexus team, that is something that has been a staple of y'all's to make sure to, if it doesn't perform, to at least get back their original principal. So that's not, I wouldn't say that's the standard across the industry itself, for the listener. And number two, one of the things to note is the challenge becomes, especially as we've lived in these volatility controlled indexes now for probably almost 10 years, has to be now, 9 years or so. And when you diversify out, because a lot of the companies started to allow you to put basically not all your eggs in one basket, you have some indexes that can maybe have done, based off the participation rates, 15, 20% in a given year. But then the other portion of the bucket was allocated to an index that basically didn't do well. So your overall between those, that diversified bucket is aligned with your 5 to 6 story. So for maybe the advisor who is the RIA, who is basically managing money and then looking at these products more so as an alternative to bonds, I mean, do you guys see a lot of people just go all their eggs in one basket, or talk a little bit more about diversification?
Yeah, we've seen a big improvement. So this year marks my 8th year at Annexus, coming up this summer, and I've been involved now in the life and annuity index industry, really for about 12 years. This actually will be my 13th year coming up, and what I've seen is an evolution where, yes, we had this knee-jerk reaction to leave the S&P. What we believe is if it has a good allocation, you should bring it into the mix, not put a bet on it. And there became this shiny object concept in 15, 16, 17, where there was just a handful of smart beta indices, and it was about chasing a back test with a high illustration. Yeah. And that was really the game. And unfortunately, the shenanigans of ignorance or deception, it doesn't matter. We saw a lot of leverage in bond allocations at the worst part to allocate the bonds, and a lot of disappointment. And what we've been trying to do is really embrace a forecasting approach. Not that we have a crystal ball, but making sure that we're not just looking in the rearview mirror. And that provides a more realistic set of expectations. And then further, how do we bring that diversification? And we're seeing that. I'm really proud to say that we are seeing that diversification. And some of it was on us. When I joined Annexus, actually, most of our products didn't allow for an allocation to numerous indices in one contract. It was easy to maybe buy 2 contracts, but that was onerous, right? So to be able to bring in one contract, that helps. The other thing is, over my 7.5 years at Annexus, we've seen rates go up. Right? Here, I remember working with Annexus on the Zebra 1 launch, and the 10-year Treasury was about 1.5% with Brexit. Yeah. And now here, 4.75. So the competitiveness of the participation rate's gone up. If you spoke to me then, I would probably tell you the expected return is probably around a 4 on an FIA. Now I'm going to say it's a 5.6, right? So we've seen that increase, ultimately still showing a better bond allocation, better bond return, or better alt return. But we have seen that play out, which we're really happy about.
Yeah, to really the listener itself, for the evolution of the FIA space, all eggs in one basket. I think that's more so what we're starting to see is diversified out and just really shooting for that 5 to 6 annualized return over the long term. That's a very safe bet. And I want to kind of put your feet to the fire, but there was a call we did. Maybe it was, I don't remember. We talked a couple times last week or last year, and I remember just it was always fascinating to me as I look back because it was just very brief. And I asked you, out of these vol indexes, which one's going to do well this year, and you just shot off the cuff like, well, I think. Actually, if there's one to look at, you should look at the macro compass, and here's why. And you gave me two things, and I was not really paying attention. I was like, oh, okay, Tom. And sure enough, as I look back, it was actually one of the better performing ones for last year. So that got my antennas up of wanting to ask you on today's show. So let's play hypotheticals, but also at the same time, realistically. So if we look at just the vol controlled indexes out there in the Annexus world, which ones do well when the Mag 7 performs? So let's say in 2025, the Mag 7 does really well. What kind of vol indexes, at least within Annexus, if you want to speak more broadly, great. Which ones do well whenever those 7 stocks are doing good?
Yeah, absolutely. And I think that the Mag 7, NVIDIA looks like it's still a great opportunity, perhaps within reason. The rest of I think that allocation does look very overvalued, even on looking at forward growth and then the earnings valuations with its PE. But to answer your question, let's say that euphoria were to continue, which we haven't seen over the last few months. But if it were, you would actually see, again, a continuation of the NASDAQ 100 type of themes doing well. You would ultimately see things that have a more growth allocation and some momentum, right? Winners become winners. So what we ultimately tried to do there is bring in within the portfolio some of those growth allocations. So specifically, right at the end of October, beginning of November, we had an index refresh with Nationwide, which we have every few years, and we're able to bring in 2 indices. We're able to bring in a risk-controlled version of the NASDAQ 100 that is sponsored by NASDAQ, and they utilize the intraday vol control technology of SALT. So it's just a more prudent measure and proactive measure of allocating to the NASDAQ. When I got involved at indices for the life and annuity market, just going vanilla NASDAQ was just too volatile. You were hit on some of the crediting parameters. So that definitely is a good hedge and anchor, and it's a price return derivative index. And the other is how we can bring in more growth into the tactical strategies. Obviously, growth can be more volatile, and we were able to extend and expand our partnership with Loomis Sales, tremendous think tank of a 99-year-old asset manager in Boston that used fiduciary principles to develop indices. And we brought in the Loomis Sales Discovery Index that was able to be not pure growth, but prudent growth, be able to tactically allocate to growth based upon their market models, which I could even spend a whole call on. So what we felt that was a missing puzzle piece to the portfolio. Not that we're saying, we're getting rid of any of the other indices, but we're building out the portfolio, and those were really key puzzle pieces. And we always look to say, what is a puzzle piece that we need to enhance and further stabilize any of our product portfolios?
And that's good for the listener to know too. So the process within the companies that your team does partner with for the insurance carriers. So consistently always being innovative. Y'all have measurements along the years to re-up and actually look at other indexes, or is that common, or is that just with that specific carrier?
I think most carriers do look at it, to be honest. I think it's interesting. Some do brand diversification, where they might be working with different banks, but a lot of the indices are doing the same thing. And we avoid that. We don't need brand. We have brand partnership. We're proud of the diverse amount of brands, but then under the hood, we have to say, what are the puzzle pieces really from a market's perspective? Different ways to allocate to. You mentioned macro compass. That looks at economic outlook. It's very different than the market signal model that Loomis Sales built for Discovery, or the momentum and optimization model Goldman has, right? If you look at our New Horizons or index or the work of Roger Ibbotson and his behavior of finance, these are diverse ways, as opposed to saying, oh, we're going to have one person build all the models. If you think about within your own organization, the different thoughts and processes, it creates a different outcome, right? That's really diversity in that way. So that's one way, strategy diversity. Then we have to have universe diversity. We're not just trying to chase one return. How are we going to actually, and you've highlighted some of the things that maybe are unfavorable over the last year, we're bringing that on because you're in this product at a very least 7 to 10 years. Now, if you're taking on certain guaranteed income riders, longevity riders, things of that nature, you could be in this for 20, 30, 40 years. Our crystal ball, first of all, no one has a crystal ball, but if you look at what could be based upon long-term forecasts with ranges, that's about 10 years. You go out 25 years, you don't know. You go out 30 years, you don't know, right? So yet the product's going to be in the client's hands that long. So you have to have all those arsenals to be able to apply in those different scenarios.
So let's do the flip side. So if there was, let's say, 493 other options within the S&P 500. So when the other 493 are doing well within the S&P, not necessarily the Max 7, but when those are doing well, which ones are the vol-controlled indexes you see that do relatively well during that time?
That's a healthier sign in the market. That is a sign of more diversity and health. And what we would say is probably Roger Ibbitz's behavioral finance research coming through, more market normalization, selling the hot stocks and keeping the cool stocks, you'd say. Or you just had on the show the other time, Professor Siegel, his value, distilling value, where we're looking at his way of looking at value and actually shorting the S&P with a dynamic allocation to harvest that premium while giving some market exposure. Those would do better. As opposed to just saying we're going to concentrate on the kind of the growthiest momentum stocks.
It's interesting because so if you go prior to when the Wisdom Tree Siegel Index actually launched, there's a great page, and back testing has nothing to do with what's going to happen moving forward. Your team's been out ahead of that, talking about forecasting. But if now the reality is hit, since that index went live a handful of years ago, I remember 2008 on the back testing report actually showed that index doing positive when everything else seemed to be cratering. And it's fascinating as you look back and you see that in 2022, the same thing happened where the bond market, equity market, both double digits down in 2022, but that index actually was up for the year of 2022. So you're telling me that even when the S&P is performing, that's a very favorable stock to look at when the other 493, and it's a more healthier environment?
Absolutely. Obviously the kind of the growth crisis of 2022, that index shined, but in more normal markets, right, where you're having a positive S&P, but a broader market, you will see the beta exposure coming through. And what I mean by beta, market exposure coming through with a tilt to value. And you see that in the analysis. We haven't had that really in most of the last 2 years. But why I believe in it is the valuation of what you see some of the growth markets. And it's like baseball. I know you're a big baseball fan. You want to have, let's say, an effective left-handed or right-handed pinch hitter, depending on who the pitcher is, who's going to come in and be able to complement and get that runner home. And if our goal is to hit, let's say, those 5-6% over the long haul, how can we get some positive returns with when we have a different situation, a different pitcher, a different market situation on the mound that we have to face?
That's a good analogy. And so they complement one another within that carrier when you're diversifying, not all eggs in the basket, but, and I've actually seen an uptick, to be honest with you, in some of the carriers, more advisors are allocating a little bit more into S&P 500 type of indexes and not necessarily shying or running away from vol indexes. But I think with the new administration, they're a little more pro and positive on the S&P. Could you actually talk to some of the indexes that have more commodity base? Like where is that in the forecasting in the future? I know you have like Grandmaster Index, you have a couple others with Loomis that have more commodity focus. How does that look?
So when we think about commodities, a lot of times people say, oh, that's really complex.
Hmm.
You go to the grocery store, you go to Home Depot, you go to the gas pump, you go to the jewelry store, you get a sense of the value of commodities. And yes, there's going to be certain commodities like gold that have had tremendous returns over the last year.
Hmm.
Phenomenal, right? And others have been lackluster. But bringing in commodities allows for diversification. Commodities tend to have a lower correlation or movement with the equity market. And as a result, it's a great diversifier. There's two ways to really think about commodities in this space, and it has evolved in the FI space, not necessarily in the commodity space. Number one, just getting prudent, just as I said, prudent growth, prudent exposure to outright commodities, actually having the index be able to go out long and get that upward exposure to those markets through futures. They are great hedges against unexpected inflation, as well as emerging market growth. Ultimately, do you want to always invest in emerging markets? You might be better off as they grow. Those markets need industrial metals. They need food. So as a result, commodities can be a great way to allocate and gain that exposure. The other thing that is also utilized now in the last few years, and we have them, and I'm going to go a little deeper for a second. Farmers would, if anyone on the call has grown up with a farmer background, would understand. And those are what we call commodity curve strategies. And that's the idea of you're actually taking the same commodity contract, let's say corn, and then you're saying, I'm going to buy the corn contract out a few months out. That's how futures work, the future, and actually short this month's corn contract. So you say, well, what's that? Well, there's the macro forces of supply and demand based upon food companies, farmer needs, storage, the list goes on, and certain pricings that allow for that arm wrestle and create those premiums. So they tend to have lower risk than just going outright. Those indices, sometimes those carry strategies tend to do better when rates do come down, I find. But we've seen them a little bit sidelined there for the last 2 years, but you're not seeing them collapse. So if we see ultimately those forces continue, you're going to see those bring additional benefit. And both outright commodities as well as the curve strategies, they do bring, as I said earlier, diversification to the strategy, which allows for a lower volatility overall with your equity, bond, commodity allocation, or whatever the optimization is, which allows for more exposure. So that actually, in some ways, allows the index to get more exposure to equities when it wants to, because there's a diverse hedge within that basket.
Tom, you're so smart.
Well, I hope I'm not losing. That's a little in the weeds to go there. But a farmer, anyone again who has a farmer background should understand that. People that are, you're going to the grocery store, you might not feel that as much.
Yeah, no, that was good though. That was that's why we have you on, buddy. That is great. I'll bring us back up to the surface level. The listener who's, especially when they're in the fixed index annuity, and final numbers aren't out as we're recording today, but I think it's safe to say 2024 was the best year in the industry when it comes to overall just sales and growth within the FIA space in 2024. So how do you forecast 2025? Do you see it as even more substantial growth, or where does your team see 2025 in the FIA space?
We at Annexus, we feel really strong about the outlook for index annuities, registered annuities, life insurance. And what I want to highlight is, a few things. We've talked a bit today about rates, interest rates. We have higher interest rates that fuels a competitive product. Here we're not dealing with 50 basis point treasury yields. We're dealing with 4.75. I think, Professor Siegel thinks that'll range probably around 375 to 5. He's given those remarks. So that creates a healthy environment. That's number one. Number two is the demographic. We just hit peak 65 2 years ago. So we ultimately have so many baby boomers trying to plan for guaranteed income, or those on the flip that actually have strong means. They're really trying to create a stable retirement. They know they have the money, but they want to think about legacy planning. They want to think about protection with moderate growth. So this is really a strong vehicle. So that's number two. And then when I think about traditional investing, it's still sobering that Morningstar actually just published, going into the end of the year, their what does the 4% rule look like?
Mm-hmm.
Here, the Bill Begnan 4% withdrawal rule. And going into 2024, it was at 4 for those that are living to 90. If you live past 90, good luck. And now it's actually lower. The 4% rule for those that are at 90 is not projected to occur.
Mm-hmm.
So that really raises the question about having the ability to get competitive guaranteed income with a leading insurance company, such as a 99-year-old insurance company called Nationwide, A+ rated, right? Where you know that a mutual company can provide that stability. Or do you see the instability right now about what's going to happen with Social Security? Bringing a Social Security readiness rider, which we have in North American. Or unfortunately, people are always faced with long-term care considerations, right? And maybe they're past the point where they feel like they can get that long-term care annuity purely or policy, but that can be incorporated in one of the annuities. So all of these needs of retirement and living through your retirement and planning efficiently for your legacy planning with that great wealth transfer, we feel creates a spectrum of opportunity. And I do think if the S&P 500 right now, the forecast is much lower. Right. I'm not saying we're calling for a bear market, but we're the fourth most overvalued S&P 500 in 125 years, according to Bob Shiller's CAPE. Goldman Sachs, just going into the new year, did a report that the S&P with dividends, I'm not saying without, that's even worse, with dividends is probably going to do around a 3 with a range of 1 to 6. So not the double-digit returns we had before for the next decade. And with this over concentration, you probably could have a more volatile market. So are you able to adjust your sleeping point with 100% S&P 500 allocation? Probably not. So what's your diversifier? And this is one of the reasons, again, from a portfolio construction perspective, we feel that the index annuity market is well positioned. So rates are very strong. Frothiness of market returns, still not enough, I think, stability in the bond market. And then the demographic. And then the last one is, I think, an understanding from a regulatory perspective to distribute these. I think there's been a tremendous, development and maturity of the distribution of the market. You have really some strong insurance companies backing these products, educated distribution. They're here going out doing podcasts like you are, leading podcasts and getting out, really showing the pros, the cons, the considerations of everything that should be done with a standard of care, best interest standard. And now I think we have more regulatory certainty on how to distribute these products. Bringing that all together also is going to be important.
That's actually fascinating. So 3% over the next 10 years S&P with dividends. Wow. So that's actually a astounding look. And I think there was last year there, I forgot, I mentioned on one of my recent mastermind calls with some of the lessons learned in 2024, there was $1 trillion in motion last year that just went to money markets. And that's not equities, that's not bonds, just to money markets alone. So with the rate environment we're in, that makes you wonder if that 4% rule is going to hold up. So with that Morningstar report, for people, I mean, consumers are hungry to move their money into, it looks like, into protecting their principal, but having upside opportunities. So that seems to be where this.
Yeah, cash. I didn't even talk about cash. Cash, with the Fed cutting rates, which I'm glad they did. We're normalizing the yield curve. That's a long-term a good thing. But you're not getting much in your money market account. So any CDs are coming up to due soon. That maybe were allocated in 22. What are you going to do with that money as well? Mm-hmm. So, what about the index annuities? If you were, let's say, looking to plan for retirement in a lower rate environment, let's say between 16 and 20, this is a good time to start thinking about, right, and doing it with your financial professional with a Reg BI consideration about rolling in there, right? We have such a competitive product, more indices, higher rates, all the above. So that could be the right opportunity for a 1035 exchange. That I don't want to blanket that overall, but for many, that is a prudent consideration.
With all the trends seem to be moving in the right direction, especially in our industry, there's got to be a lot of interest. I know we're seeing a lot of institutional banks. We're seeing a lot of people who are first timers in our space itself. And I know, as you are, you're the expert, you're on Wall Street. So you really have your thumb there, chatting with specifically banks and different teams that are looking at the FIA space itself. So anything on the horizon or players, is there a reason why they're looking into our space here for index strategies, carriers, anything moving forward?
Well, investment banks on the street, and again, I'm speaking to you from my home outside New York City in North Jersey, they really do value supporting the insurance industry. And I think the index business, there's been an evolution, I think, of them, their involvement there. But overall, they find it as a more stable source of revenue for them, probably versus hedge funds or versus some sovereign wealth funds. When you look at some of the more tactical chief investment officers, or very institutional type of trading books and hedge funds, they are trading with the entire street, out in, out. There's a lot of risk. Hedge funds want to really make money and really act to certain ways that banks sometimes, I would say, have to take lower revenue. And with insurance, it's a much more slow and steady outcome. If you look at the indices overall, you're seeing a lot of stability. You're seeing them able to accrue. Index annuities are principal protected, so you don't see big drops, right? You're seeing growth. So the banks like that because it's a safer, I think, method for them to diversify their own businesses. And they, for the most part, have been able to show profitability. Now, my job is working with our insurance company partners that we want to get that accountability from Wall Street banks. We don't want them to overcharge us. Like anything, Wall Street and capitalism is a very powerful thing that allows us to progress our economy, our financial products in a good way. But if we're getting ripped off, right, if that's ignorance or deception, I don't care. We have to make sure that we're getting good pricing. And thanks to you, Jeremy, and all the marketers and advisors within our framework, it allows us to have a lot of purchasing power. What we do is Ron Schertz, our CEO, and myself, we're out there at an executive level with Wall Street banks, driving that accountability, making sure that we're not getting shenanigans in the index strategies, right? You have to really pass our index diligence process, but the pricing metrics so that we know that, yes, we have competitive pricing day one, but more importantly, stable pricing. So those renewal rates, we're not having drops. And well, the Wall Street bank just did a sneaky one on us, or they didn't think through that risk, and now they pull back on the price. And I think net, again, going in my 8th year at Annexus, the renewal rate history that we have on our smart beta indices since I've been there has been tremendous. In some cases, nationwide, 102% rate renewal stability, not 102% par, but that the ability of renewal rates actually going up. Where else would you see that? As opposed to those who flock to the S&P, it's not that the insurance companies have purposely done that. In some instances, they have. If you're seeing really high double-digit caps, they're not affordable, and they potentially could renew them down. But also the S&P itself. Let's say you're seeing other rate renewal things that come out, and you get the drop. It's also part of the market.
And actually, and you mentioned something too, and I know in January, so being with you out in New York, and that's, I mean, as real as it gets, really, especially for advisors, RIAs that are new to this space, being able to hear from your team out at Goldman Sachs, go to the New York Stock Exchange. I mean, it's a great partnership of what you all at y'all's team has actually put together. So, I think moving forward, I'm pretty optimistic as our industry continues to grow from the infant stage of never even the thought of doing 100 billion in a year. And now here we are surpassing that twice. So I'm pretty optimistic. Is there, for the listener who's getting to know Annexus a little bit more, anything that is on the horizon that Ron would actually allow you to speak to, or what's going on there?
I think what we're out on the horizon is out there really helping you and educate our advisors. Yes, we're always working with our carrier partners, trying to make sure that the products are relevant. We're involved on our initial rate settings, our ongoing rate renewal rate settings. We're so intimately involved. We're involved in our campaigns and our education outreach. So that's our table stakes. And then we're always thinking about within the Annexus 360 portfolio where we can bring other value add. I think our product portfolio is leading. We have a leading guaranteed income and accumulation, enhanced death benefit planning, RMD readiness. A lot of times, that's important, and how we can do that even tax efficiently with QCDs, and we have that with our BCA product, or having the first of a kind retirement readiness rider. That's on the annuity side, and then on the life side, right? We talk a lot about annuities on these calls, but also how to bring in life insurance, which is so important. For financial planning and legacy for younger ones, to even those that are patriarchs and matriarchs of families, and how to do a generational wealth transfer efficiently. So we've been able to build out that initiative as well in our product lines.
Yeah, and y'all have had a couple of breakthroughs last year. John Hancock, right? Or was that 2 years ago?
Yes.
Yeah.
That was the first time in arguably, decades of, maybe the first time in their 160-year history, they did an external partnership, and we're able to bring in the PRISM index. It's obviously an index dear to my heart, one I personally built when I joined Annexus, but also we're able to bring a crediting method called a booster, which actually allows for clients to have a higher probability of positive returns, even in some of those lackluster markets, which is important in a life insurance policy. There are additional charges in life insurance policies, COI, cost of insurance. So how do we make sure that in a policy that zero is not your hero in that case, we're able to achieve having a stable product return within our clients' portfolios?
Mm-hmm. No, it's great to watch the expansion, and New Horizons is what y'all are consistently pushing. I know with the team there. And as we're wrapping up, anything that we missed or any final thoughts from Mr. Haines?
Well, I think this year we're going, as the Professor Siegel, there's going to be a lot of interesting turning points in the market, right? We have this arm wrestle behind high interest rates,
mm-hmm.
debt ceiling, and having Washington move forward on some of the things that are expected,
mm-hmm.
global markets, and the geopolitical sensitivities. All these things are going to be really interesting to play out over the next few months. It's going to be hard to see how they play out. I'm hopeful that we will have that, but we need that. And to think that we're going to be isolationist isn't going to work per se, because 40% of our revenues from the S&P 500 come internationally. So we need to see the rest of the world get its act together. We need to see, I think, stability in the bond market. And then some of the things that the president-elect has planned through, hopefully we get through, right? In a way that the art of the deal leads us to have that broadening in the market and stability in the market, which will, I think, help drive strong returns for our clients. Again, going back to the expectations we talked about.
Great stuff. Always good insight. Very good insight, Tom. Thank you for your time today. And also thank you to the listener for tuning into this week's episode. Make sure to subscribe on your favorite listening device to the Advisor Mentorship Podcast so you don't miss out on any future episodes. Make sure to connect and follow us on LinkedIn and also Instagram, and subscribe to our YouTube channel at Jeremy Hauser Amp. And as you share this episode with a friend or a colleague, remember, in a world full of betas, be an alpha.